Hi, Peter Rose, Longwood Currency Trading. I'd like to chat with you today on a kind of a convoluted topic. The title of the video is Forex Trade Entry Time Frame Differential Analysis. Man, that's a mouthful. And by the way, it is me, Peter Rose, despite the hair. You notice, maybe you don't notice, maybe this is your first time watching videos. Why don't you go back to the past 50 videos that I've done? You'll notice that my hair gets constantly longer through those videos. I hadn't had my hair cut in just about a year, and decided the other day, we're getting ready for Thanksgiving here in the United States. If you happen to be here, it's November 24th right now, and that I'm recording this in 2020. And so I just thought I'd verify that it is me, despite looking different. So the topic, man, that's, oh, and I'm out here, by the way, because it's really cold out. We're in full gear for stick season, as you can see up on the hill up there. The leaves are all down. We are deep into it at this point. I came out because I wanted to bring my dog out to have a run up the hill. Bo, come on, let's go, go, go. There's the Bo dog, mini Australian Shepherd. Smarter than I am, actually. My wife is up visiting her aunt up north today, or this afternoon. So I have the task of taking the dog out to walk through the woods a little bit. I just brought him out. I've been out here for a little while, so. Bo, come on. Bo. Yeah, there you go. He gets distracted like I do. So I'm just going to walk up here a little bit, and then I'm going to go back inside the house because it's cold. It's probably 37 or so today, 36. It was down to 14, I think, last night. And we had a nice fire on the wood stove, and we're going to have another fire tonight in the wood stove as well. But I thought I'd get started on this video out here and then go back inside. But before I do, I wanted to say that though the title of the video I'm going to do is Forex Trade Entry Time Frame Differential Analysis, the real title, and this is explained in a blog post that I did at longwoodcurrencytrading.com of a similar title, but I explain that the real title should be Proportional Time Frame Differential Analysis of Forex Trade Entry Target Points. Blah! I can get away with that shit because I got a degree in physics and I got a lot of math and stuff behind me. And well, that's a mouthful. What does that all mean? Well, basically, and when I get inside, I have some slides that I'll put up that'll define this stuff. But basically what it means is I'm a short-term trader, and it's my position that I can take my short-term skills and map those up onto the long-term charts and be a long-term trader. Whereas I feel that the long-term folks have a very difficult time in mapping their skills down into the shorter time frames. And in fact, there's a violent disagreement among long-term traders that short-term traders are no better than some cottage cheese laying out in the sun. It's going to spoil pretty soon. It's going to go bad. Premised on all of the trading that we have is based on our profit targets that we're shooting for, and the amount of initial risk that we're willing to take on the trade in order to get that process moving. And so the debate here is that the short-term trader has such a short a risk point because they're only looking for a small profit target that eventually, if you don't have a good win-to-loss ratio, that the losses will far exceed whatever it is that you're going to win. So you have to have a pretty good win-to-loss ratio, which I think you can do on the shorter time frames because you're not trying to shoot for 100 pips or 500 pips or whatever it is, and experiencing drawdown or retracements of 200 or 300 pips. That could be a retracement, or it could be a reversal. As a short-term trader, I don't want to wait around for 100 pips or even 50 pips to figure out whether I'm wrong or not, or the trade's going to go against me, or I'm going to lose 100 pips of my trade because I'm trailing a stop behind it, and I just don't want to do that. But the premise of the video is, can I take can you, I know I can, but can you take those characteristics of profit targets and stop points, the initial stop loss point, and can you translate those up into their proportional equivalents on the longer term time frames? That's what the point of all this horseshit is. Proportional time frame differential analysis of Forex trade entry points. You gotta love it. Stay tuned. Wow, it was cold out there, and so I'm inside, and you know what I just noticed, boys and girls, is that I was wondering why I was hungry. It's lunchtime, so you know what I'm going to do? I'm going to get some lunch, and then I'm going to get a cup of coffee, and I'm going to sit down in my library and do this video for you. I'm kind of waiting until a little bit later in the afternoon, so I don't have to throw a frickin' towel over the window to get the sun from blasting in through the windows. So we'll see how that goes. In fact, let's wander in there and see what the light is like in the library right now, because maybe I should film this now instead of wait. Are you getting dizzy swinging around like that? Hey, it's not too bad. Well, let's see. Light looks pretty good. So maybe we'll do that. But lunch first. Okay, well, I'm basically settled into the library. I have my coffee with me. And I have, I wrote the blog post before I did the video. And that presents difficulties because when you try to read stuff on a video, it's very forced. But because the topic, again, is sort of linear, I have to stay on with a specific train of thought in order to convey my thoughts on this thing. I have to refer to that blog post as I go through. And as I had mentioned, I had done some slides that I'll post up as this video proceeds along, so that you can kind of see in a little bit more detail the kinds of things that I'm talking about. So if I look down, I'm looking at the conditions of my slideshow and all that other stuff. It'll be a mess. It's not going to be quite as smooth as I like to, but I would like to shoot through it. In other words, we're just trying to look at how we would translate certain characteristics that we're familiar with on one time frame, the profit target and the risk, for example, and migrate that up or transpose it up onto another time frame or another currency pair or something like that. So the idea is, can you proportionally do that so that it makes sense? And so the two conditions that I wanted to chat about as an example of this problem was, first, is there a way to calculate that stop point proportionally up onto, say, a daily chart where the ATR is 300 pips? And I'm coming from an example of a short-term trader using a 8-pip stop on a 15-minute time frame with an ATR of about 10 pips. So we're looking at proportionally adjusting that 8-pip stop on a 10-pip time frame to a weekly chart, say, or a daily chart that has a 300 pip ATR. And then another question would be, well, what if you have to? What kind of value would you have to use if the ATR on that 15-minute time frame all of a sudden goes from 10 pips to 20 pips? I mean, what would that look like? So we'll get in and we'll chat about that in a little bit more detail in just a second. But a little bit, maybe a background on me, just as a short intro. I mean, you know, I've got a physics degree and a math degree and all that. If you've watched any of my videos before, if you don't, none of this is going to make sense anyway, so grab a coffee and entertain yourself with me as we go along, because it won't be meaningful. But as a short-term trader, I have some very specific characteristics that I use in my own trading. I use the 15-minute time frame charts to determine both price action directional bias and for all of my trade entry analysis. In other words, where do I put the profit targets and what kind of risk management am I going to use? I do that on that 15-minute time frame. I use the 5-minute chart for executing the trade. And when do I actually do that trade? It's going to be based on what's going on that 5-minute time frame. And down on the 5-second time frame, I do parts of my trade management. So that's my view of the market and how I trade that market. Now, as the proportional analysis that I'm going to do for you in this video will show, is that my use of the short-term charts, and as a short-term trader, I can transpose all of that knowledge and training up onto the higher time frames. But it's my position that it would be very, very difficult for a higher time frame or a longer term trader to map their skills and be successful down on the shorter time frames. As I think I mentioned that on my way in from walking the dog outside. So those are the two issues that we're going to deal with, those two examples. And so let's take a look at a, let me bring my thing up here and see what I'm looking at. I'm going to pull a chart up, and it's chart 2. And it says that the following chart displays the specific base process I use contrasted with the ATR situation on different time frames. So on the left side of that chart, you see an ATR for my 15-minute, 5-minute, and 5-second chart. And on the other side, on the right-hand side, you see the weekly, daily, and 1-hour time frames and what their associated ATRs are. Now, these calculations, and in fact the setting of the 8-pip stop and the 20-pip profit target that I'll be stating is valid in my case, has to be taken into context with the time that's being done. That's why I said, well, what happens if the 15-minute time frame ATR goes from 10 pips to 20 pips? So my characteristics that I'm working on right now with the currency pair that I'm trading, the 15-minute time frame, which is my upper time frame where I'm looking for directional bias, has a 10-pip ATR. Correspondingly, on the weekly time frame of that same currency pair at this particular point in time has a 300-pip ATR. So the proportional balancing that I'm going to look at, and this isn't complicated, it's just arithmetic, that I'm going to look at are going to see, can I map my 8-pip stop on a 10-minute time frame to whatever that value is going to be up on the weekly time frame. In fact, the next chart that we're going to take a look at is titled a proportional time frame differential analysis. It's chart 3. I'll read it for you. It says the following chart shows in the first section, which would be the 2 horizontal rows, shows in that first section the translation of setting the 8-pip stop on the 15-minute trade execution chart to that of what it should proportionally be at 240 pips on the weekly execution chart, which is basically 80% of that ATR. So 8 pips of my 15-minute time, 8 pips of my 10-pip ATR on the 15-minute chart is 80% of that ATR. So I'm just taking 80% of the ATR up on the weekly chart and calling that 240 pips. So that's where that translation for that comes in. Now the second section shows the situation of changing the stop value of 8 pips on the 15-minute 10 pip ATR to a 16 pip stop when the ATR changes to 20 pips. Again, it's just a proportional change. 80% of 10 pips is 8 pips for my stop. 80% of 20 pips is 16 pips on a 20 ATR, right? So that's where those calculations come from. Now, again, these are not calculated values. The ones that I use, the 10 pip on the 15-minute ATR, giving me an 8 pip stop. You could say that there was a mathematical relationship there, but there isn't. I trade on the 15.5 and 5 second. I just said I'm going to use an 8 pip stop, and because of the price action down on that 5-minute time frame, I'll set a 20 pip max profit target, because that's going to happen or occur before perhaps a price retraction or maybe even a reversal will hit. So it all it does is it gives me a higher probability on the lower time frames of getting to 20 pips than it would if I was trying to get to 200 pips on a higher time frame. Right? That's all that's saying. But the important thing to note is that the proportions that I am using to move those values from the 15-minute chart to the weekly chart, those are calculated. But the original values that I chose were static values that I just picked out of the air. They aren't calculated values. Okay? So you just really need to understand that in order not to screw yourself up if you're going to try this exercise on your own, which I'd suggest that you do, because many times there's different information that you can find that's on one time frame that's not on another. And so during your trading session, although you might be using one time frame to execute your trades on, you may be looking at other time frames. Did the directional bias change in the 2 hours that I've had this thing on? Has anything else happened? And so you may be consulting other time frames. And so you need to say, well, what if I decide to trade on that time frame? Should my stop remain 8 pips? That would be my question. Or should I drop it to 3 pips? Or should I increase it to 50 pips? And those are the questions that we're really trying to resolve here. So the issue is about risk control. I mean, that's really what we're looking for as a trade entry. What you do after trade entry is called risk management. Okay, we just need to be clear on that. I don't think I've ever heard that differentiation made in, and you can see that from the fourth chart thing that I've put up there, is that risk control is what you do at trade entry, whereas risk management is what you do after you change that initial stop order to a limit order to close the trade during price action as the trade moves on. And so, I mean, you don't really need to know that because you just kind of intuitively do that sort of thing. But I think there is a need to know that you're doing something different when you're doing trade management than you do when you're doing trade entry. So the crux of me just arbitrarily setting that 8 pip stop, for example, let's just take that, is, and again I'll pop up a slide here, slide number 5, is that it says, this is my trading approach. In my case, I totally eliminate the entire issue of risk control analysis by having a static 8 pip loss. This leaves me free every time I look at a trade entry situation to focus on the profit target analysis. And I even take it one step further in my trade management. At certain points, if I have a lot of profit. I've chased that thing up 30 or 40 pips, and now it's starting to chatter a little bit. I might give it that same 8 pip movement before I take it out with my limit stop. If I have not made very much profit on the trade, then down on that 5-second chart, I'm gonna probably jump out after 3 pips of adverse move. I'm not going to go the full 8 pips. I'll save that extra 5 pips because the lock that I want to give to all of my trades is at least 5 pips. You can make 5 pips a day, 4 days a week. You're making a huge percentage return on your money just on 5 pips. So if we go to slide number 6, I state that my primary objective as a trader is to quantify my risk such that I know immediately if I'm correct or not in my trade entry and then again in my trade management. I think it's important in this discussion of transposing my 8 pip stop to a 240 pip stop up on the weekly. I'm not sure that that's quantifying my risk. 240 pips is a shithouse full of pips to lose to find out that your trade entry was incorrect. I think that's crazy. I think it's ludicrous, and because my primary objective, again, I'm reading from slide 6, my primary objective as a trader is to quantify my risk such that I know immediately, not 4 hours from now, but immediately if I'm correct or not in my trade entry. And then I go into my trade management. And that can change. You can have that. Okay, so we pull the slides down. So the question that I voice is, can you make that arithmetic migration or transposition of an 8 pip stop on a 15-minute ATR up onto an ATR with 300 pips? Well, yes, you can. It becomes 240 pips. But why would you want to do that? See, that's the key to the thing. Why would you want to do that transposition? On a 15-minute time frame with an ATR at 10 pips, I've got a 20 pip or 2 ATR profit target. Most people use a 2 ATR as their risk. I'm using 2 ATR as my profit target down on that 15-minute chart. But look, is that even, there's no mathematics to that. You can say mathematically, oh, I'm going to take a 2 ATR stop, but you're not going to say mathematically, I'm going to take a 2 ATR profit. I arbitrarily set that 20 pip profit target because I feel in a 15-minute time frame, I'm far more likely to achieve a 20 pip profit than I would be in a weekly time frame in getting a 600 pip profit target, because that's what that 20 pip profit target translates over to on the 300 ATR chart. So would you want to do that? Would you want to say, well, because I'm trading on the weekly chart, I'm going to have basically a 2 ATR profit target? Well, no, you're not. You're gonna say, okay, I'm trading off the weekly. I'm actually trading on the daily, but I'm looking at the weekly for my directional bias. So you have to calculate if you're going to do those translations, you have to calculate it. The ATR translation is done at the high time frame, the directional bias time frame, because that's probably the length that your trade's going to have to run in order for you to hit the profit target that you're looking for. when you're actually using your trade management down on the next lower time frame. So if I'm up on the weekly time frame, then I might be trading down on the daily, right? I'm looking at the weekly for my trade directional bias, and I'm doing my trade management down on the daily. So if I'm looking at my directional bias as a short-term trader on a 15-minute time frame, then my trade management is being done down on the 5-minute, and then the ultimate 5-second when I'm looking for chatter and for a price that's going into some type of a profit target scenario. So it is translatable, but the issue is you can't you can't say that because I'm on a weekly chart with a 300 pip ATR that my profit target needs to be at least 600 pips, or I'm not going to go in and take the trade. But that's just crazy. You know, you may be looking at that weekly chart for your bias and trading on the daily and saying, hey, I'd be happy with a 60 pip or an 80 pip profit, or maybe a 200 pip profit, but not a 600 pip profit. That doesn't make any sense. It makes sense down on the time frame as a shorter term time frame that I'm doing than it does on the higher time frames. That's why a higher time frame person would have a hard time translating their trading down onto the shorter time frames, because if they're going from a 50 or a 60 pip stop because they're looking for an 80 or 100 pip profit target, their reward to risk is in great shape. But if they try to translate that down into the lower time frames, what's going to happen is that you end up with maybe a 5 pip stop and a 10 pip profit target, and it just doesn't make any sense, because that would just make them crazy. And 5 pip stop that's too tight. I mean, the VIG just to trade is 3 pips, right? And, you know, you got to pay your bid-ask spread. That's your VIG. So call it 3 pips, a pip and a half on the way in and a pip and a half on the way out, or maybe it's only a pip and a half. 3/4 of a pip going in and 3/4 of a pip coming out. I don't give a shit what it is. It is a lot of pips just to play the VIG when you're down on a 5-minute trade management chart. You know, your 5-minute ATR of 5-6 pips is basically only twice what the VIG is. Whereas if you're up trading for 50 pips, what's a pip and a half to pay in VIG? It's nothing. And so that's another reason why the long-term traders don't like the shorter-term trading, because they say that your transaction costs, that VIG, is so much higher as a percentage of what you're shooting to make. And although that's true, I feel that it's easier to make, again, it's easier for me to make 3 or 4 or 5 pips net on a trade than it is to make 50 or 60 pips on a trade. And because it's easier from not only from an experience standpoint, but also from a probability standpoint of judging the volatility of that price to make it, to go to 20 pips, I can at least grab 10 of those pips and say, okay, 10 pips on $1,000 is $10. But on a $100,000 account, well, man, it's a lot of money, right? So you can't just blow 10 pips off. My premise on this whole thing is you can't expect to take a small account and make a lot of money. You might be able to grow a small account to a larger account over a long period of time. Most people wouldn't have the patience for that, but you're not going to grow a small account to a large account quickly. That implies taking too much risk. There is an inordinate amount of risk down on the short-term time frames, but I think there's an equal amount of risk on the longer-term time frames. It's just on the longer term, you have more time to recognize your risk. For example, if you're setting a 50 or a 60 pip stop and the stuff starts floating back against you, you can say, well, you know, I'll stay with it a little bit longer. Oh, maybe I'll just get out now because it doesn't look good. Whereas if I'm doing that on a short-term time frame, I can't afford to let that stop float lower. It starts to go. I got to get out, because if I lose too many times in relationship to the number of times that I win, in other words, my win-loss ratio, if that isn't very good, then those loss values will in fact overpower anything that I come up with for winning trades. You know, if I have three huge losses and 5 mediocre wins, I'm not going to make up the difference. It's not going to work out. I'll take my account to the wood. I think that's why a lot of beginning traders fail, is because they are not experienced, so they don't have a good win-to-loss ratio, and they're going to lose a lot of money. In fact, they lose all their money. But more often than not, I find when I work with a student that they've been trained incorrectly to look at the incorrect goals and in the wrong order, so that they would be more inclined to do this type of proportional analysis, thinking that they were going to gain something because of the best practices, so-called, of the longer-term trader that has that. Well, I'm going to put this next slide up, which is my thoughts on what I call plain field agnostic trading. So the question was, can I make transitional proportional calculations across time frames? You can. The question was, would you want to do that? The answer that I've just given is no, you probably don't want to do that. So regardless of the time frame that you're on and how you feel about your trading, these are what I call plain field agnostic trading, the plain field being the time frames that you're on or the currency pair that you're trading. So here's my principles. I only look to assure myself with a high degree of probability that price will go at least 20 pips before there's a potential retracement event. And I don't care whether I'm trading on a 15-minute time frame or I'm trading on a weekly time frame. It's 20 pips. If the price goes further, I'll follow it as far as it goes. And that's why you have a higher time frame bias to look at, so that you can say, oh, well, there's structure that's at 20 pips, but there's also structure at 30 pips, at 60 pips. And so you know where your next expectation of probabilistic chance is that you'll be able to achieve that if the price does run for you. Because if price goes further, I'll follow as far as it goes. Next, because I'm only looking for a potential profit target of 20 pips, first, that 20 pips should be an easily obtainable goal if my probability entry analysis has been correct. That's the key to it. I've got to have a good entry analysis, or I'm screwed right from the get-go. But it doesn't make any difference in short-term or long-term trade. If you don't have a good entry analysis, you're screwed. But that is quantified in my world, whether I'm short-term or long-term trading. That 20 pips should be easily obtainable goal if my probability entry analysis has been correct. Second, even if it doesn't make the 20 pips, I'm happy to close with just 3 pips, because, boys and girls, 3 pips a day, every day, is over a 60% annualized return. No shit. Do the math on that. 3 pips on a $1,000 account is $3. $3 a day times 5 days a week. It's $15 a week, $60 a month, $600 in 10 months. That's the 60% return. So you can't piss at 3 pips. And 3 pips on a $100,000 account, that's a lot of money. Okay, so you can't. That's money. It's only 3 pips, but it's a lot of money. And the third thing is that my static 8 pip hard stop is close enough to give me notice that I was wrong in my trade. and I can exit with minimal damage to my account. And because I only use that static 8 pip hard stop, number one, that stop is just large enough to provide enough price, some breathing room to make that 20 pip anticipated move. I can have a little breathing room, but 8 is enough. It's a little over an ATR on the current 5 pip ATR that I have on my 5-minute chart. So, secondly, the static 8 pip hard stop combined with my 20 pip profit target means that my reward to risk ratio of 2.5 puts me in just super shape. So look, I've got great reward to risk, better, as good if not better than if I'm playing on the longer term charts. So I think I've got the best of both worlds. That's my opinion. That and maybe $1.50 will buy me a cup of coffee. And my name is Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.